Happy Friday, everybody, and a happy Friday it is on Wall Street. I'm Jeff Hirsch, Editor-in-Chief of the Stock Traders Almanac, and this is WealthWise on Biz Talk Today TV. Today's featured guest is my friend Tom McClellan, market timer and technician extraordinaire, and keeper of his family's eponymous and famous indicator, the McClellan Oscillator. We're going to dig deep into the oscillator and the summation index. I'll bring Tom on in just a few moments, but as usual, here's what's on my radar. The rally has gotten some legs. I'm going to share my technicals chart here and some other things. So you can see, let's just minimize this right here. You can see that this is yesterday's close, but I threw a green arrow in where it was about to close. What are we? We closed S&P at 5687 above our 5670 level. We're still below the 200-day. We made some progress on the downtrending 50-day, this pink line here. So again, trust but verify, getting close. We're starting to verify some things. We still got some, some stuff to clear up here. The old election gap that I've been highlighting, the middle of the W123 bottom that failed before, the 200-day. I have this 5770 line, goes right through this gap area. So back, we got back into the Qs, the QQQ and the IWM, the Russell 2000 ETF. Couple of weeks ago, working out well. I own both of them myself. That was to sort of play the rest of NASDAQ's best 8 months. I know that everyone's talking about sell in May and go away. I like to say you got to buy in October to get your portfolio sober. Best 6 months switching strategy, something Yale created in '86 in the Stock Traders Almanac. November to April, the best months. May to October, the worst months. But nobody ever said sell May 1st, and we did get our sell signal in April on the 3rd with our MACD trigger. So for NASDAQ's best 8 months that we're back in the Qs and the Russells is it ends in June, and we can get our MACD sell trigger there. We'll use the 12.26.9. It can happen anytime on or after June 1st, the first trading day of the last month of the best 8 months. So you can check my newsletter at stocktradersalmanac.com for more on that. Let's just look at some of the other technical charts here. The Dow has some work to do. What do we close about? 41,317, right under the 50-day here. You can see, we're way off the all-time highs. This is the end of year, December 31st. So we're still down for the year, still way off the highs. So we've got some work to do there. NASDAQ making some progress through these, support now, resistance numbers. We closed below 18,000 today. It was a 17,978, rounding up there. So again, through the 50-day, still looking at the 200-day, the election gap. Both of these are downtrending, but again, we're making some progress. We got to get through 18,000 here. So that's encouraging. So, we want to ride this rally here a little bit. Here's my my post-election year seasonal pattern chart. I do think we're running the risk of some old school Republican post-election year weakness, where Republicans tend to come in and let's see, is there something I'm missing here? Oh, okay, never mind. My producer's just chatting with me here. What we're seeing here is some typical sort of weakness for post-election years with Republican presidents, where they sort of come in and take names and take care of a lot of drastic measures early. That's what we're seeing with the down Q1, down best 6 months, down April, except for NASDAQ was up a little bit. We blew through the December closing low indicator for the Dow, and here we are sitting below these Republican administration lines since 1950 and the incumbent party loss line. Yes, we're having a nice rally, and this rally can continue into the NASDAQ's best 8 months, the rest of them till June, maybe early June, into early August potentially. But if you remember in 22, we had an August drop. A mid-July peak, and we've had some other weakness in Q3 and post-election year. So this post-election year pattern is warranting caution for me. We had the third worst 100 days for any president since 1945. The first was when Ford took over for when Nixon resigned in August 74, just before the bottom in October of 74, the big bear market bottom for the S&P. It was December for the Dow. The second worst was Nixon's second term in 73, which was the beginning of the generational 2-year bear. Neither a great company. Number 4 was 2001, W's first term, right in the middle of the dot-com bust bear market. So when the first 100 days are down and my best 6 months are down like we have in 2025, weakness has continued, and the years were down in 4 out of 5 of those years: 73, 74, 77, and 01. So this puts my worst case scenario at about 60%. Not the worst thing. It says, in the forecast we put out in December, we were leaning 8 to 12% base case scenario, about 65%. Worst case was 10%, where we'd be teetering on bear market recession territory, and we have a flat to negative year. The Trump administration and Republican Congress are taking too many drastic measures. That's kind of happening. Yes, we have a strong rally, remains to be seen. We're still leaning towards the potential for, these 2 lower lines to happen once we sort of revert to the mean here. So with that, I am going to bring my friend Tom in here. Tom McClellan is the editor of the McClellan, Market Report newsletter for the past 30 years. He works with his now 90-year-old father, Sherman McClellan, creator of the oscillator, the McClellan Oscillator, and the Summation Index. I believe your mom had something to do with that as well. We'll get into that in a sec. He's a West Point grad, and he went to a reunion there. Was it 2 years ago or 3? And he called me up, and we got together with Marvin Appel. So it was like the Sons of Wall Street Icons breakfast. It was a great call. It was great to see you then. We had a lot of fun over here near my office in White Plains. 11 years as an Army helicopter pilot. Very impressive. But he has continued and extended the work that his parents started. And he is, as everyone knows, one of the most foremost experts on stock market breadth indicators. And just a great guy. I get his newsletter. I love it. So just great to have you. Welcome, Tom. Great to see you. What was your highest rank in the Army, if I may ask?
I was a captain in the Army when I got out in 1993. You may recall that some new people came into power in Washington, D.C. in 1993, and they figured out that we weren't going to have wars anymore, so we didn't need this big army. So let's let everyone go, and that worked out really well. So
worked out well for you.
I was part of the peace dividend of lots of people getting out of the Army at the time, but I had something else I had gotten interested in doing. I was a young captain on flight pay, and I had more money coming in than I absolutely needed, and that made me suddenly much more interested in the work that my parents had done many years before. So I started studying the stock market, and one big day that changed it for me. I was stationed in Germany. I was out at the Grafenwehr training area. Anybody who's ever stationed in Germany knows Grafenwehr and range 301, and I had owned 100 shares of Marion Merrill Dow, and they got bought out by somebody with a tender offer, and there I was in dirty battle dress uniform out in the field wearing a Kevlar helmet, and I made $1,000 doing nothing. I thought, this is the kind of job for me. This is a pretty good deal. So,
nobody's shooting at you.
That got me hooked.
Yeah, awesome. So you're an engineer as well, right?
I was an aerospace engineer at West Point. Studied all the reasons why airfoil going through the air causes lift and drag, and it was interesting, and put that to work flying helicopters. And actually, I was a maintenance pilot in the Army in addition to being a cavalry scout pilot. So I was the guy that would watch the mechanics put it together, and then before they let the regular pilots fly it, I would take it up to make sure that everything worked right. And it was super satisfying job, really interesting technical stuff to do. But I approached charting kind of as a pilot, and I found that among my subscribers, and there are 3 common fields that I see a lot that embrace technical analysis. Pilots are one of them, musicians are another, and doctors. And the commonality that all 3 fields have is that they are used to looking at visual information
Yep.
and making a decision based on it. And so if you're a pilot, the attitude indicator is wrong. You need to level the wings. If you're a doctor, oh, look at the tumor on the x-ray. Or if you're a musician, you need to come in on the downbeat. And the key is there's visual information and you need to make a decision. Not everyone, it turns out, thinks visually like I do. And so not everyone is attracted to doing chart analysis. They want to get their information other ways. But people for whom visual information is useful seem to be drawn to what we do.
Works for me. You know, my father was a musician
Yeah.
and a composer. So I've spoken about it, that I really think that not just the visual charting stuff that you're talking about, but just the first of all, the lyric writing enabled him to spin phrases and present information clearly, but also the mathematics of writing music and understanding how some of these indicators are built. Just before we get into some of the details of these things, how's your dad doing these days? I know I was working with my father when he was 90. You know, he made it to 98, and around 90, he was still pretty sharp. But you know, it was starting to. There were some signs when I look back on it.
My dad is still very sharp, still driving. He's
Wow.
going to be guest speaker at a conference in New York City in June, so I'll be going there to see him. So he's still sharp and doing great. My mom
Maybe.
passed away in 2003. She had cancer, and you mentioned that she was involved with it. She was instrumental in it because
Mhm.
my dad was really interested in the stock market. My mom happened to have been a math major in college
That's
back when
right.
it wasn't really fashionable for young ladies to major
Yeah.
in mathematics, but she knew how to do integral calculus and plot things, and so it really took the talents of both of them because she was the computer. This was back in the 1960s when nobody had PCs or even really good adding machines, and so all the work that they did in 1969, really leading up to the creation of the McClellan Oscillator, was all done plotting numbers on ledgers and then hand plotting them on charts. And
And graph paper.
in graph paper, yeah, white graph paper, and without both of them doing it to get the computations done and then figure out what it means, it would have happened.
That's how I learned it. I keep this little ruler that I used to underline the upticks in the Dow, half hour ticks and out of Barron's. So wait, before I go, you said you're going to be in New York in June.
Yes, I will.
I assume that means I'll have to come into the city and say hello.
That'd be great. We could get together. Yeah, the Foundation for the Study of Cycles is putting on a conference of a
Oh,
bunch of
good. Great
cycles
group.
experts.
Yeah,
So,
yeah. That's a great group. So like me, you know, we both worked with our folks early on. There were some great moments, but there were some tough ones. How was it working with your folks in the beginning? I know you, how old were you when you got into it with them? And
well,
you're,
it was different for me because I had left and gone to West Point, and then I was in the Army. So I was away from home for a long time. And by the time I came back and started laying the foundations for what became our newsletter in 1995, I was already a grown up and had two kids. And so it wasn't like I was trying to seamlessly go from the callow young teenager into an adult. I had some separation time and that was good. And before we
yeah,
got the newsletter started, I was actually working for my parents' other business. They had not had a newsletter before I got involved, but they had run a plastic injection molding business back in downtown Los Angeles, making aerospace and computer parts with high precision molds. And so I went to work for them and learned how to do sales and learn how to drive a forklift and program a CNC milling machine and a coordinate measuring machine and doing all the things you needed to do to run a precision manufacturing business.
so how and when did this oscillator come about?
Well, it was in 1969. And I'll tell you a little bit about my dad. He was a business major at Claremont Men's College in California, and he learned all the normal ways, all the fundamentals, and all the reasons why stock prices are supposed to move. And he very quickly found out that those are all wrong, and it didn't work. And he had an interesting experience. His family, his grandmother had owned the family farm back in Illinois. They had it leased out for several decades, and she would just be managing it. And so they had a tenant that was running it, and the deal was that the owner got half of the corn crop. So once a year, you had a big decision: when do we sell that crop? And when my dad first got out of college, his grandmother wanted him to take over managing the farm, and so he had to learn about, well, how do I make that decision? What makes corn prices move? And he quickly learned that if you try to sell the corn crop in September and October, which is harvest time when everybody else is trying to sell it, you don't make very much money. So he studied the charts and the history of corn prices and found out if you wait till about March, then all the hog farmers are now quickly running out of their supplies that they bought in September, and they need to refill their hoppers to feed the hogs. And so you want to store up the corn until March and sell it then, and then you make a whole bunch more money. So it's
So he
very
was
much a market timing issue. When you've got one trade to make a year and it's only a sell, you definitely want to time that just right. So he was leaning toward market timing from the very beginning.
But I'm hearing he was a student of seasonality as well.
Sure. Well, and back in the 1960s, you got to understand that for trading, there was no ETFs. There wasn't even any no-load mutual funds. Regular people did not trade stocks.
No.
You couldn't, because the commissions were like 3% each way. And so you'd get killed if you try to jump in and out like we get to do today. But what he noticed as an investor was that probably 2 or 3 times a year, there was an important low. And that if you bought your stocks at that low, then you got a much better dividend yield for all the dividends that you're going to be collecting on that stock for years to come. So he wanted to figure out, well, how do I figure out when those 2 or 3 times a year are? And that's what led him to initially look at advanced decline statistics and to try to do some work with that. And I can talk a little bit about that if you want to go to some charts.
But wait a second. Before we go to the charts, let me just say, how does the oscillator work? I mean, how is it constructed? It's measuring advancers and decliners, but what's the construction of it? Can you give it to us sort of briefly, or do you want to use a chart and show us?
Let me use the charts. So
Okay, go ahead.
Give me a second. That's who I am. So the McClellan Oscillator is based on the advanced decline statistics. Every day, so many stocks go up, so many go down. If you plot that on a cumulative basis, that's the daily advanced decline line. And we pay a lot of attention to this because sometimes you see a bearish divergence where prices make a higher high and the advanced decline line makes a lower high. We saw that just recently earlier this year with the S&P 500 made a higher high and the AD line made a lower high. That's a big bear market indication. This is only updated through Thursday. Add another 2,000 to that today. And actually, as we were talking here on Friday, there's a little bit of a scandal because stockcharts.com is showing in their data that the NYSE AD line is at a new all-time high. They use the same data that I use, which is Wall Street Journal data, but my data show that it's still 2,000 units away. I've checked their raw data quite a ways back. I can't find the anomaly, so I've reached out to Chip Anderson. We'll try to get to the bottom of that. But right as of now, the New York Stock Exchange advanced decline line is still 2,000 net advances away. So what my parents did was they would look at the daily advanced decline difference, which is all these little tick marks on top. And it's really noisy data. You can be up 1,000 one day, down 1,000 the next day. They smoothed that with two exponential moving averages known as the 10% trend and the 5% trend. And modern people call that a 19-day and a 39-day exponential moving average. We have stuck with the originalist terminology that was coined by a guy named Pete Harlan back in the 60s. And Pete Harlan was the guy who introduced exponential moving averages to the stock market. And that it's a 10% trend because every day that 10% trend will move 10% of the distance between the old value and the new data value. And the 5% trend is slower, so it'll only move 5% of the distance. And the difference between those two,
to the MACD type of stuff, but this is on the AD line, not the price of the index.
Yeah, Gerald Appel borrowed the idea of looking at the difference between two moving averages from the work that my parents did.
Wait a second, that I didn't know. I didn't know Jerry was inspired for the MACD by the McClellan Oscillator.
Yeah,
I can't believe that didn't come up during our meeting with Marvin. Maybe I just missed it.
We talked about it then. And, because lots of people had been using moving averages of different types and including exponential moving averages. But the key insight that my parents had was looking at the difference between two of them. So now in this chart, the red and the green line are really hard to see. So let me change the scaling and take away the raw data. So this allows you to see that the faster moving average, the red one, the 10% trend, and is when it's above the green one, the 5% trend, you have a very high McClellan oscillator value. And then when they cross, the oscillator goes down through a zero, and then you can get to a big negative one. So you're really tracking the fast moving average versus the slow moving average. And that's what the McClellan oscillator is. And
So
it does
just to summarize, the McClellan oscillator for the listeners is the difference between the 5% trend and the 10% trend?
Yes, 10% trend minus the 5% trend. So it's the space between the two moving averages of the daily breadth.
Excellent.
So what is it doing right now? Well, this is up through Thursday because I didn't have Friday's number. We had about 2,000 net advances on Friday. So this is up a little bit, but it is still at a lower high. So we currently, versus prices being higher, we currently have a bearish divergence in the McClellan oscillator. And that's a big topping indication. But the problem is you can have a bearish divergence for a long time before it finally matters. So just because you see a bearish divergence like we see right now doesn't mean that it has to matter. The other things that the oscillator does when you get down to a very, very low level, that's a sign of exhaustion. It means that you've accelerated downward about as hard as you can accelerate. You can always get a little bit more overbought or oversold. So just because it's at a very low value doesn't mean it can't go to an even lower one. But the rubber band is officially stretched when you're way down here. When it gets up
when
to
it snaps back is when you get a signal that,
yeah,
right?
and that's so. And even if you are early and you buy in when it's oversold, but it's not quite the final day, you usually get made whole on the ensuing rally if you're a little bit early buying a nice juicy oversold condition like this. When it gets to a really high overbought condition, though, that's important because you don't usually get the final price stop at the highest oscillator reading. And we've seen that again this time.
Suggests to me that we got a little bit further to run on this bounce back rally.
What the oscillator is showing is it's showing acceleration. Think of it like the second derivative of the advanced decline data. And so it's showing a lot of acceleration, which you're going to see in the fat part of the uptrend. And the way that the stock market moves tends to resemble like a bouncing ball. So you get very sharp bottoms and you get rounded tops, like a bouncing ball does. And so the most dramatic acceleration for a bouncing ball is when it hits the floor, and the most dramatic acceleration upward is part way up, and then it rounds over, and you can see diminishing velocity and diminishing acceleration. We're in that rounding over process right now, but when is it going to end? That's the harder question. Now, the thing you got to know about this idea about the highest high not coming at the end of the rally, that's true when you're in an uptrend. When you're in a downtrend, like we were in 2008, you can get a blow-off counter trend up move that peaks the oscillator and prices at the same time. And this was really frustrating for a lot of people. You'd get huge, strong breadth and huge upward acceleration in the advanced decline data, and the market wouldn't follow through with it. Finally, in 2009, after we had the Mark Haynes famous bottom in March of 2009, finally you got a strong initiation reading in the McClellan oscillator, and it kept going. And that was a sign that something was different. So the question is, are we still in uptrend mode, or are we transitioned to a downtrend mode right now?
How do you read this?
I'm reading this as we're still in a downtrend, and we got overly done to the downside. We have to correct that. We have to do an overly ambitious snapback to the upside. I could be wrong, and if we keep seeing positive breadth coming in, then I'm going to have to change my mind. But for now, I'm still seeing us as in a bear market for this whole year, and the market's gotten it overdone, and we got some more correcting to do.
Bear market rally from your point of view right now.
That's my point of view right now, and I reserve the right to change it. I change my mind sometimes multiple times a day. If you get stuck on one opinion and stay there, you can get run over. So I have very strong opinions, loosely held.
I'm with you on that one. You were looking at 08, 09. What is that telling us? What can we learn from the 08, 09 chart
Well,
with respect to this year? Anything?
you're asking a great question. And the point about that is that the rules are different in a bear market. In a bull market, you get strong initiation and you get more coming. In a bear market, you get what looks like strong initiation, but it's just a snapback. Now, so all you got to know is, am I in a bull market or bear market? And then you can make interpretations really easily. But you and I know it's really hard to tell sometimes whether you're in a bull market or a bear market. And it's even harder to tell when that's changed. But what the clue is here is if you get strong initiation like this with a really big, fat, high oscillator reading, and it doesn't lead to continuation, that's a tell that you are in a bear market. And so we should have that tell in a few more days from now
Okay.
as we enter into March.
So if the oscillator falls off and the index falls off,
Yep, then we know that it was just a
more like the
snapback.
bear market situation.
And I wish we had that information right now because I'd really like to know that information right now. But we just need a few more days to know.
Sometimes you need a little hindsight, right? Just a couple more days of hindsight.
Well, I like to say that information is valuable and sometimes it costs you a little bit to get that.
Yep. All right. You got
Oh, well, part of what I want to talk about is the expectation of being in a bear market this year. And part of that comes from this relationship, which almost nobody knows about. I'm the one who discovered this over a decade ago. And what I found is that the movements of the stock market tend to match the movements of crude oil prices with a lag time of about a decade. In other words,
this is
whatever
something I've
crude oil
seen you
price,
do a lot. This setting different indexes forward. So that's pretty cool. How did you, how come, how did you see this? Like what was the inspiration to move one index or one asset class 10 years forward to relate to another correlated index?
well, it started when I got my hands on a bunch of historical data on crude oil prices going back to 1890. And there weren't any cars in 1890. And crude oil had just been discovered in Pennsylvania in, I think, the 1850s. So there wasn't like a huge market for crude oil, but there was a little bit of one. And so the Foundation for the Study of Cycles assembled the data and took it back all the way to 1890. And so I plotted just the crude oil prices on a chart, and I thought, boy, that looks an awful lot like the plot of the stock market. So I put the two of them together on a chart, and it was a little bit dissatisfying because it didn't quite match up right. It took a little bit of tinkering. And what I finally found is that if I shift forward the crude oil prices by 10 years, voila, the key fits in the lock, and everything makes much more sense now.
There's that pilot musician visualization at work.
Yeah, that's what it took to get everything
like when
to sync up.
people, flip a chart upside down or turn around and take the names off and say, hey, what do you see here?
Well, but you got to understand that stock market data upside down doesn't work right because you're changing the physics of how people behave. The stock market doesn't work that way. And in fact, if you look at stock price data versus corn price data or gold price data, they just have very different behaviors. And so that's I know what you're getting at when you should just look at the chart, but you have to understand what market you're in because they all have different personalities. Let me take you through this chart a little bit further. I want to zoom in on what's happening right now, just so we can see what use it is and what problems that it has. This is the same comparison. This is oil prices shifted forward 10 years, and I'm comparing it to the Dow. And you can see that oil price movements get echoed 10 years later in the Dow. Not perfectly, and not perfectly 10 years either. So for example, the great oil price bottom in November 1998 did get echoed in stock prices, but it was 5 months later than exactly, or 4 months later than exactly a 10-year echo. So not exactly perfect. There's some anomalies that happen. So for example, crude oil prices briefly doubled back in 1990 when we had Iraq invading Kuwait. That little anomaly did not get echoed in the stock market. So that was just an exogenous event, like the COVID crash in oil prices. I expect that's going to be an exogenous event that won't get echoed. Also, we see that the magnitudes don't always match up. This decline in crude oil prices was a lot bigger than the decline that echoed it, but it showed up on time. Similarly, the big decline in 2008 in oil prices, it did get echoed in the stock market, but just in miniature. Sometimes you have something like the COVID crash, which affects the stock market, and you just got to put your thumb over that part because you can't blame oil prices for not knowing 10 years in advance that we're going to have a pandemic. But generally
Kind of like
speaking,
the
the market,
'87 crash too.
well, yeah, off of this chart a little bit, and that was just a bit of an anomalous event that is going to happen sometimes, and you have to accept that. Now, oil prices peaked in June of 2014, and then they sold off a lot because the U.S. started fracking, and OPEC initially tried to resist that, and they finally gave up, and oil prices declined really hard. The peak that we've had just now was late 2024 for the Dow on a monthly closing basis. It was
Right.
into February on an intra-month basis. And so that was a little bit late versus June of 2014, if you're looking for exactly 10.0 years. But now we're finally getting to the program, and we're echoing the oil price decline. And if we continue to follow it like it's been happening for 120 years, then we should ideally expect a bottom in January of 2026 for stock prices. Now, that's ideally, but as I've shown you, sometimes the actual turn doesn't come in exactly 10.0 years. So sometime around the end of this year, early next, we get an important bottom, and then we get a great bull market lasting all the way to 2018, or excuse me, all the way to 2028. So I'm sure that President Trump will declare that he deserves all the credit for turning everything around, but all the seeds were already in the ground.
So my
Make
my
it happen.
4-year cycle hat sort of comes on here with the 2026 or post-election year, midterm year bottom, and then a peak in the 27, 28. But
For sure. And that will matter also. And it's amazing that both things can matter. I like to say that in the stock market, the stock market is a polytheistic environment. There's no one God that's in charge of everything. There's multiple gods that all have their own influence. Like in Greek mythology, you got the god of this and the god of the harvest and the god of war. There's lots of different gods that were all involved. And in the stock market, people can do Elliott wave analysis, they can do moving averages, they can do cycles, and it all matters. There's no one thing that controls everything in the stock market, so it all does
so
matter.
in a nutshell, what's crude telling you right now?
Well, crude oil prices had this big COVID dip and rebound. So long about 2030s, we should not do this big dip. So just ignore that. But generally speaking, crude oil prices went up and they've been going back down. If crude oil stays down, if drill baby drill works in 2025, that's great for drivers. It's not going to be great for the stock market in 2035. But we've got 10 years to wait around for that.
You've got a read on the Fed and interest rates as well, correct?
I do. This is the way that I have figured out is best to know what the Fed should do. What the Fed actually does do is different than what they should do a lot of the time, and that can create a problem. But if the FOMC would just stop thinking that they know everything and would just listen to the 2-year Treasury note yield, they would do a lot better job because it knows where they're going before they go there. And they create problems by delaying. But when we saw Greenspan was working on his legacy back in the mid
Right.
2000s, he kept interest rates lower than they should have been, and he fueled a real estate bubble. And then he was asleep at the switch, getting the rates cut, and we had the great financial crisis. He had turned the reins over to Bernanke by that time, but the Fed made drastic cuts faster than they'd ever cut before, but it still wasn't fast enough to keep up with what the 2-year note was saying. Back in the 2010s, they were fueling the everything bubble by keeping rates really low. They had zero interest rate policy, even though the 2-year said it should have been a little higher. They finally woke up to what the 2-year was saying, and they started hiking. COVID crash came along and blew everything up. But now here we are again. The Fed is keeping rates high because they think that they know better. But the 2-year says we ought to be down around 3.6%. So you could cut a half a point off the Fed funds target and still not catch up to where the 2-year has already gone.
What's your feeling on when they'll cut?
Well, they got a meeting next week. I'm much better at declaring what they should do than what they're going to do, because you get 12 people sitting in a room together. Who knows what the discussion is going to be?
Even they got some political or face saving, you know, forces at play there. I don't know if they're going to be able to cut in March after all the talk that they've had out there.
And that would probably disappoint the market if they don't cut this month in May. And that may be what kicks off the sell-off. They've got the inflation data, they got the payrolls data to give them the justification to start cutting a little bit more. But the problem is that Trump has been strongly encouraging them to cut some more, and they don't want to look like puppets, and so they have to act like they have to resist a
Kind of
little
like
bit.
telling your kid what to do.
Yeah, then the kid makes the kid want to do the exact opposite. People are funny that way.
So
Um,
Powell's a rebel, huh?
well, and that's, he's a human being. People don't like being pushed around and told what they're supposed to do, especially when they're the ones who are supposed to be in charge. And so it's a natural human tendency for any human being to resist against that, especially when somebody as loud as Trump is telling them what to do. They feel like they got to show that they're not his puppets. And so I suspect that they probably won't cut next week, but they should. And if we could save a lot of money, we could have a lot better policy, and we could save a whole lot of money on travel expenses if we just outsource interest rate policy to the 2-year and not have the FOMC set it.
There's too many economists there. Too many PhD economists.
400 PhD economists working at the Fed. Can you believe it? I wonder if Doge is going to take a look at how many economists does it take to run the Fed, but that's a whole different topic.
Reminds me of long-term capital. But anyway, so let's wrap up the Fed. You had one other look at the interest rates, right? Oh yeah.
Well, this is one other look at what the Fed does,
Yeah.
and this is super wonky data. I'm looking at reverse repurchase agreements at the New York Fed. Now, you're going to start falling asleep when I talk about reverse repurchase agreements, because it's the Fed and banks getting together to agree to borrow treasuries to make the banks' balance sheets look cleaner or not. And when the banks do that, when the banks borrow treasuries from the Fed, they agree to pay them back later, and the Fed agrees to purchase them back later. But while that's happening, the banks have to pledge some of their deposits as collateral for those treasuries. Now,
Is
the
this
bank
quantitative
deposit,
tightening?
this is very much like quantitative easing and quantitative tightening as in terms of its effect, but this is not exactly the same thing. It's just another different way to accomplish pushing more money into banks, into the banking system, or taking money out. So this is reverse repos, and I've plotted it on an inverted scale, and I've shifted it forward 5 trading days to reveal how the movements of the reverse repo data tend to show up 5 days later in the movements of the stock market. It's pretty amazing. And if you think about what it's doing, it's money that's either coming out of the Fed when this blue line, this inverted plot goes higher. That's money coming out of the Fed and into the banks. And if it's going lower, that's money coming out of the banks and into the Fed. And so when there's more money available to lift stock prices, we get stock prices going up. And when there's less money, we get stock prices going down. So it's very much a liquidity thing.
Maybe a little bit of a pullback in this rally over the next few days from this trend.
There should be. It's overdue to have started. We keep continuing, gone up for 9 straight trading days, which is not complying with what this model says should happen. And that can happen from time to time. Eventually, though, they do get back together, and I expect that to work. It's a miraculous thing, and I wish it would give us more of an answer than only 5 trading days ahead. But I'm not in charge of setting the physics of the market. I'm just in charge of trying to figure out what the rules are.
That's right. So I've got a few other things I want to ask you about. I really appreciate you running through all the technicals and what you're looking at here. Some definitely interesting looks. Let's unshare the screen, unshare your slides, and talk about a few things. So you cover a lot of this in your newsletter. Your newsletter covers a lot of ground. What is? I mean, there's a lot in there. You cover most asset classes. What is your focus in the McClellan report there? What is the general drive of the newsletter? What are you
Well,
trying
we
to
have
do?
2 different publications. We have a daily edition and we have the twice monthly McClellan Market Report. The basic idea is we give a weather forecast for what the stock market's going to do for as far out into the future as we can and with as much precision as we can. And sometimes it's cloudy and we can't see as far. Sometimes it's better. Our general approach is that liquidity is what matters most. I like to say that there's only two fundamentals that matter. The first is how much money is there, and the second is how much does that money want to be invested. And if you change either of those, then you move prices. And so if you think about, well, what about regular fundamentals? What about earnings and dividends and book value? And none of those things change factor number one, which is how much money is there. The Fed is in charge of that. But all those other things that people think matter that get talked about on financial TV, those factor into factor number two, which is how much does that money want to be invested? And I say not how much do the people want to be invested, but how much does the money want to be invested? Because you and I, we get to participate in the stock market and we get to vote on higher or lower, but we only get to vote based on how much money we bring to the table. So somebody with a bigger pile of money gets to vote harder than we get to vote, and that's what really matters.
That's why the bond market runs the world pretty much, right? So what do you recommend to your subscribers? Different stocks, ETFs, commodities. What are the types of things that you tell people to suggest that people put their money in their portfolio?
Well, we have such a diverse set of subscribers that we can't give one set of recommendations that applies to everybody. So we try to figure out what the stock market is going to do. And I have really some really smart subscribers. They usually know what's best to do for their own portfolio once they know what the stock market is likely to do. I can't tell everybody who's trading futures or who's trading, grandma's 401k the same advice. You just can't do that. We do have some individual stocks that we track as part of our partnership with our money management arm, Global Investment Solutions. So that's featured in our daily edition. We cover stocks, bonds, and gold in every issue because those are the main areas of focus for us, mostly because we're stock market guys at heart, but gold is really interesting. And gold is kind of funny that I talked about the stock market making movements like the path of a bouncing ball, where it makes sharp, spiky bottoms and rounding tops. Gold does the opposite. Gold makes sharp, spiky tops and rounding bottoms.
You think
wonder
we got a top in gold here?
What? Pardon me?
You think we got a top in gold here?
I do. And we're supposed to have one just from a long-term cycle perspective. There's a 13.5-month cycle. It has an important mid-cycle low that we're due to have a dip into. We'll see if we can get some further advance on the other side of it. There's a lot of global demand for it. But the thing about gold is it makes spike tops while the stock market makes spike bottoms, which has to do with human panic. When we panic out of stocks and into cash, but we also panic out of cash and into gold. And that's why the spikes tell you about what's happening with the panic.
What about the gold stocks? The miners and such.
That's a tougher one because they have a foot on in the stirrups of two different saddles. Sometimes they are gold stocks and sometimes they are gold stocks. And so sometimes they follow gold and sometimes they follow the stock market, which makes it really hard. Generally speaking, if gold's going to keep on going down for a little while longer, and I expect it to, that's going to make it a rougher environment for gold stocks. And so you really can't bet that gold stocks are going to go up in an environment when gold is still coming down off of a blow off top. There'll be another time when it'll be time to get back into gold stocks.
Yeah, we have a little bit of a seasonal short on the gold stock miners. So what is it that you're keen on now, either shorts or longs? What are you, what stocks or sectors or asset classes are you focused on for, moving money into?
Well, I'm looking for a bear market for the overall stock market for the rest of this year. Could bottom as early as November based on some other leading indicators that I follow, but in a bear market, there's plenty of trading opportunities, but you got to understand what game you're playing in order to know what shoes to put on. You can't wear your basketball shoes on a muddy soccer field. And we are on a bear market year, but so you need to trade that accordingly. I am expecting that the drill baby drill and lower oil price idea is not going to work out as well as a lot of people are hoping, and that oil prices are going to go higher. And I expect that based on looking at the commitment of traders data, which shows me that the big smart money commercial traders, they are usually right when they get to an extended view, and they are usually in crude oil, they're usually net short all the time. And that's because a lot of them are producers. But right now they are net short to the lowest degree in years. They're saying this is not a price level that they want to go short at. And so
Okay.
that
So
they
they're
don't want
saying
to
crude bottom.
crude. I don't want to say crude bottom, but crude should be doing better than a lot of people expect for the next several months. And so therefore the refiners and the exploration companies are probably where you want to be there. I'm expecting corn prices to go up for the next several months, and not
Also,
irrespective of what tariffs are doing. And so if you want to look for a play on how to do that, how to play that in the stock market world, look at fertilizer companies because they
that's
should,
interesting. I like that.
yeah.
We have a
When
trade on the DBA as a sort of a hedge against, dollar weakness with all the ags, um,
yeah.
at ETF. But that fertilizer stocks, I like that.
Well,
And it's the
and the
time of
funny
year
thing
for
is,
that too.
when corn prices grow up, corn farmers respond by buying more fertilizer because they want to maximize their yield more and spend more to do that in a year when prices are up. So you get a very, very
This
good correlation between potash manufacturers and corn prices.
and this goes all the way back to great grandma, right?
There's some influence there, yeah.
Any thoughts on the tariffs and this trade war?
Well, tariffs are a tax. Taxes harm the economy. Uh, whether it ends up being worth the price is a whole different question. I'm not very good at declaring what the policy should be, but I know that we're going to go through some pain. And when you have an environment where investors see a lot of uncertainty, like for example, right at the beginning of World War II, right after Pearl Harbor, stocks went down all the way till May of 42 because there was great uncertainty. Are we going to get into the war? We've gotten into the war. What's that going to mean? Is my son going to have to go? Are the Japanese going to invade California? When there's great uncertainty, everybody keeps their wallet on their hip. But then you get a moment when the uncertainty ends and people start feeling like it's going to get better. In May 1942, it was the Battle of the Coral Sea, where the U.S. Navy and the Japanese Navy duked it out, and the U.S. Navy kind of came out on top a little bit. Not hugely decisive to end the war, but it looked like, hey, we might be able to fight back against these guys. That was the key. That was the turning point moment where the uncertainty shifted and people started thinking like, oh, okay, I think I know how to think about this now. Right now with tariffs, uncertainty reigns everywhere. Nobody knows what the tariffs are going to be. They don't know what they are today. They don't know what they're going to be next week. What are the Chinese going to do? What are the Japanese going to do? What are the Koreans and the Europeans? Here's uncertainty everywhere you look. And so people feel terribly uncertain and feel a lot of angst about that. There will come a moment, and I don't know when the moment will come or what the spark will be, and it's probably not till later this year, but there will come a moment where suddenly people will start feeling less uncertain about tariffs and everything. And that will be the shifting moment when we get back into bull market mode. I think it's likely to come in November. That's when we return to positive seasonality, among other factors. And we have to go through a summer of anxiety and thrashing out negotiations between the different countries. And it's going to take a while longer. But the key is that feeling of uncertainty is what causes people to change their behavior. And we're not yet at that shifting point.
Yeah, I'm with you on us having some rough sledding through Q3. So, what's I mean, you're an engineer, you're a market guru. Any feeling on AI and tech these days? Anything there that does anything for you, or is that not even something you're focused on?
AI is great. I'm a big fan of using Grok. I don't Google things anymore. If I got a question, I'll Grok it because you get
Okay.
much better answers. AI is another iteration in the long string of this changes everything, which dates all the way back to the invention of the railroad, which was the first communication revolution across our country, and then the telegraph, and then the telephone, and radio, and TV, and then the internet.
I go back further. I go to indoor plumbing.
Thomas Crapper, yes, that was pretty big.
These are the things that part of my super boom forecast, the things that I call the culturally enabling paradigm shifting technologies.
Yeah, and AI is one of those. And AI is amazing. And it's going to have a lot of effects that we don't necessarily know how to incorporate. But back in 1999 and 2000, when people started talking about valuations and problems. And I was instructed by a famous money manager at the time, Tom, you don't understand this. The internet is different. It changes everything. Well, you can get overly invested in the internet. You can get overly invested in fiber optic cables. You can get overly invested in AI. It is possible. So we're going to see that people tend to overswing at the extremes. And so that's possible. Then they overswing going the other way, trying to exit. And then the market finds its stability and it'll sort itself out.
Anything else on your radar that we haven't touched on that I'm forgetting about?
Well, one of the things about the big rally that we've seen in gold is that long-term interest rates tend to follow the movements of gold prices with a lag time of about 20 and a half months. I didn't bring a chart of that, but so 20 and a half months ago, gold prices were down around 1,800. You know that they've recently visited 3,500. Yes. So long-term bond yields get to go through the same dance steps that gold went through as we going to get to see over the next few months. And so while the 2-year note yield is saying the Fed needs to cut short-term rates, I'm not excited about making long-term bets on interest rates at the long end of the spectrum for the next few months.
I'm with you. We like the short end as well. So anything coming up for you? Anything new? Any events you're coming in for what is the that your father's speaking at
the Foundation for the Study of Cycles is hosting an event in the city. It's in June. If you search, I don't have the information on that right in front of me, but if you search on the Foundation for the Study of Cycles New York conference, you can find it online. And Larry Williams is the keynote speaker. A lot of other interesting guys.
Oh, fantastic! He was my first podcast guest. He was my inaugural guest.
So if you're into cycles and interesting analysis, it should be an interesting time. And I'll be in New York City to attend that as well.
I have a feeling I'll see you there, and we will have.
I hope so. That'd be great to catch up.
Yeah, for sure. So just to wrap up, how do people find out about you, and what's the best place to go for more on the McClellan Oscillator?
Hang on a second.
Oh, we're gonna get a slide.
Here's information. Here's our website. It's mcoscillator.com. It's just a contraction of the McClellan Oscillator. We got a twice monthly newsletter for $220 a year. We got a daily edition for $660 a year. You can get both of them. If you don't want to spend money, you can get our free weekly chart in focus sent to you by email. It's just one chart and one article every week. Whatever strikes my fancy at the time. It's a way to get more people acquainted with our work, but it's kind of like the drug dealer model. You give samples of away, but the good stuff will cost you. But we don't sell our list to anybody. So if you sign up for our free weekly chart in focus or for our newsletter, you'll never get spammed because of that. We don't share our list with anybody. We don't hit you with ads because it's a golden rule thing with us. We treat people the way we'd want to be treated.
Excellent. All right, Tom, I really want to thank you for taking the time out, and thank everybody else for joining us. Again, I'm Jeffrey Hirsch for WealthWise on Biz Talk Today TV, available wherever you stream your podcasts. For more information on the Stock Traders Almanac and my newsletter, you go to stocktradersalmanac.com. You can check me out on social media at Almanac Trader, and just Google it also. So again, happy Friday, everybody. Thanks, Tom. See you next week.